Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. I'm Eki Ismawati with NPM 2341241 from Accounting Class 23A. In this video, I will explain about bonds. Definition of bonds. A bond is a debt security issued by a government or a corporation to raise funds from investors. In other words, when investors buy bonds, they are actually lending money to the issuer, which can be a government or a company. In return for the money they receive, the issuer promises to pay periodic interest, which is called a coupon, and also repay the principal amount when the bond reaches its maturity date. Bonds are considered one of the important instruments in the capital market. Compared to stocks, bonds are generally viewed as more stable investments because investors receive fixed interest payments over a certain period. Characteristics of bonds. Bonds have several important characteristics. First is the face value or par value. This is the amount of money that will be repaid to the investor when the bond reaches maturity. Second is the coupon rate, which is the interest paid periodically to bondholders. This payment can be made annually or semi-annually depending on the bond agreement. Third is the maturity date, which is the date when the issuer must repay the principal amount to the investor. Finally, bonds also have an issuer, meaning the party that issued the bond. Bonds can be issued by governments or corporations. Types of bonds. There are several types of bonds in the capital market. The first type is government bonds, which are issued by the government to finance national development and public projects. The second type is corporate bonds, which are issued by companies to obtain funds for business expansion or operational needs. The third type is zero coupon bonds. These bonds do not provide periodic interest payments, but they are sold at a discount and the investor receives the full value at maturity. The fourth type is convertible bonds, which are bonds that can be converted into company shares under certain conditions. Advantage and risks of bonds. Bonds offer several advantages for investors. First, bonds provide regular interest income, which makes them attractive for investors who want stable returns. Second, bonds are generally considered less risky than stocks because investors receive fixed interest payments. Third, bonds are suitable for long-term investment, especially for investors who prefer stable income. However, bonds also have some risks. These include interest rate risks. When change in interest rate can affect bond price, credit risk, which is the risk that the issuer may fail to pay interest or principal, and inflation risks, which may reduce the real value of returns. In conclusion, bonds are important instruments in the capital market because they provide funding for issuers and investment opportunities for investors. So that's all for me. Thank you for watching and wassalamualaikum warahmatullahi wabarakatuh. Bye bye.